Welcome, and thank you for tuning in to Policy Pulse, a KBRA podcast series highlighting regulatory developments that may impact global financial market participants. I'm your host, Emily Nadler, a director on KBRA's investor relations team with a focus on regulatory affairs. This podcast series gives you insight into the latest regulatory trends and upcoming changes to global financial policy. Join us as we navigate the complex regulatory world and offer perspectives from industry leaders, key investors, and policy experts. In this episode, I chat with Ryan Mensing, Associate General Counsel who covers regulatory affairs for KBRA's legal team. Ryan and I discuss a draft issues paper by the International Association of Insurance Supervisors, IAIS, on structural shifts in the life insurance sector, which was published in March. The draft paper focused on life insurers' increased allocations to alternative assets and the rising adoption of cross-border asset-intensive reinsurance, AIR, transactions. The IAIS closed their public consultation period for the paper on June 2nd, and KBRA submitted a formal comment given our leadership in the private credit space. Ryan and I provide an overview of the IAIS paper and also walk listeners through KBRA's comment letter. Hi, Ryan. Thanks for joining me again on Policy Pulse. To start, I think it might just be helpful for our listeners if we walk through some of the topics of the draft issues paper, and then we can go through KBRA's comment letter. But just first, quick background on the IAIS. It is a voluntary membership organization of insurance supervisors from more than 200 jurisdictions, and it serves as the international standard-setting body responsible for developing principles, standards, and other supporting material for the supervision of insurance. The paper we are going to focus on in this episode, Structural Shifts in the Life Insurance Sector, was published in March 2025, and a core focus of it is the growing use of alternative assets within life insurer portfolios. The IAIS observes that the shift towards alternative assets offers insurance companies numerous advantages, including diversification, increased potential returns, and better alignment with long-term liabilities. However, they do note that this shift also introduces risks, including valuation uncertainty, illiquidity, and complexity. The IAIS noted that given that insurance and financial markets are different in nature, scale, and complexity, supervisory practices and regulatory frameworks vary pretty widely across jurisdictions, which complicates comparability and risk assessment. Hidden leverage, conflicts of interest, and information gaps can exacerbate these risks, which makes robust risk management and oversight necessary. The IAIS notes that while overall global exposures remain modest, a small number of insurance companies have significant concentrations. So, Ryan, given some of the risks that the IAIS has observed, what are the regulatory solutions that they propose in this paper?
Sure. First, one of the challenges that the IAIS notes in the paper is that many jurisdictions do not have a formal definition of alternative assets. And this is really definitely something that we've seen in the market. We'll get into how we think about private credit at KBRA, but I think it's important to note that within the space, different firms can have different definitions of what qualifies as private credit or what is an alternative asset. So what the IAS is proposing here is to develop a principle-based definition of alternative assets, which they propose in the following way. They would define it as alternative assets are assets which display a high degree of either valuation uncertainty, illiquidity, or complexity, or a combination of these. And the issues paper goes on to come at this definition really from three different perspectives or three different supervisory dimensions. First of all, valuation uncertainty, that reflects limited market data or infrequent pricing or reliance on complex models. Illiquidity, it reflects the difficulty in selling assets at or near fair value, especially under stress conditions. And complexity reflects the structural or legal features that obscure risks or require specialized expertise to manage. So within the issues paper, the IAS on the back of that definition also proposes a classification system for alternative assets based on these principles, which includes private equity funds, unlisted equities, unlisted property trusts, private credit funds, structured securities, among others. So within the paper itself, there is a table, which I would encourage listeners to take a look at more closely for the full proposed mapping.
Thanks for that, Ryan. And I also want to highlight a section of particular interest for us, which is the IAS's discussion on the role of credit rating agencies in the risk management of alternative investments. Though the IAS highlights the potential for over reliance on credit ratings, they really affirmed the value that credit rating agencies provide, particularly in evaluating complex or opaque investments. The issues paper notes that credit ratings help investors evaluate the credit quality of complex instruments by reducing information asymmetry and informing credit risk capital requirements. In many jurisdictions, credit rating agencies are subject to formal regulatory oversight, including governance standards and disclosure rules aligned with international norms. Another area that authors discuss is asset intensive reinsurance, or AIR. The paper walks through some of the risks associated with AIR and suggests potential steps to mitigate them. So I would encourage listeners to look at those sections in more detail, but I want to turn now, Ryan, to our comment letter, which focuses more on the alternative asset side of the paper. So alternative assets are obviously an area of interest for KBRA as the leading credit rating agency in private credit. We actually rated our first feeder fund transaction in 2019, and we now have rated over 1,000 transactions within the private capital space and have worked with over 100 sponsors. So, one of the areas that we focused our comments on is the need to balance risks, opportunities, and the regulatory perceptions of alternative assets. Can you walk us through KBRA's views here?
Sure. I mean, as you noted, we think it's critical that policymakers and supervisory authorities really strike a balanced approach when assessing associated risks and opportunities in the alternative asset space. I mean, that's really a central theme of our response. It's critical that they look at the opportunities. And what I think you see in the issues paper is that while the draft issues paper does recognize some of the benefits of alternative assets to a certain extent, it also risks relying on some misperceptions of alternative assets and arriving at its conclusions and ultimate recommendations. So I'll give you a few examples of that. So first of all, the paper notes that life insurers have traditionally relied on high quality bonds and equities to meet their long-term liabilities, but the prolonged low interest rates and the need for higher returns and diversification have led insurers to increase their investments in alternative assets such as private equity, real estate, infrastructure, hedge funds, and private debt, and that this trend has continued even though interest rates have begun to rise. But from KBRA's perspective, while we agree that traditionally life insurers, particularly in the US, have relied on high quality bonds to meet long term obligations, we've observed that few life insurers with material allocations to equities. This is really in contrast to non life insurers who traditionally have allocated a larger proportion of their capital bases to equities. And in fact, from our perspective, the continued trend among life insurers towards alternative assets, despite rising interest rates, strongly suggests that investment drivers are not limited to interest rates and higher yields. And instead, we think these investors are also considering a variety of additional factors, including the ability to enhance management of duration, diversification, and credit risk. For example, you can also look to the Chicago Federal Reserve, which has also noted that stronger covenants can be negotiated in the private debt market, stronger than those that are typically afforded in the public debt market, and that's contributed to lower default experience. Also, given the sustained expansion of the life and annuity business across multiple jurisdictions, private credit markets offer insurers a means to originate and structure assets with cash flow profiles that more closely align or more closely match the timing and duration of their liabilities. So this enhances asset liability management effectiveness and reduces reliance on the often limited supply of appropriately matched fixed income instruments available in the public markets. One other issue that I'd flag that we address is the IAIS's characterization of hidden leverage as somehow unique or a unique feature of alternative assets. The issues paper emphasizes that exposure to leverage can be hidden within private credit funds or insurers' investment portfolios in various ways, specifically highlighting that any investment fund or ABS with pooled credit for assets, for example, credit funds, real estate debt funds, and CLOs, may have underlying borrowers with leverage and financial conditions that can be difficult for supervisors, policyholders, market participants, and other insurers to fully appreciate. But in our view, it's really important here to highlight that hidden leverage is, in fact, not a unique feature nature of alternative assets. While ongoing concerns regarding hidden leverage should certainly be addressed, it's really helpful to recognize the meaningful measures and tools that are already in place to mitigate these risks in this space. For example, regulatory requirements that call for disclosures to be made to investors and supervisor authorities, while CRA analytical frameworks account for hidden leverage and evaluate investment management infrastructure and oversight. Just one other example, KBRA credit ratings of NAV loans incorporate the total net and gross leverage within a portfolio of assets that secure the relevant NAV loan. Having said all that, though, certainly, nevertheless, we would agree that enhanced disclosure standards in this space could certainly be a useful tool to further mitigate risks and alleviate concerns.
One of the other things that we also focus on in our comment letter that I think is important here is highlighting the ways that life insurers manage these risks that the IAS flags. Can you talk about how, from KBRA's perspective, insurance companies are working to manage these risk exposures?
Yeah, sure. I mean, again, I think it comes back to this concept of balance that we talked about earlier. The draft issues paper highlights the potential risks associated with alternative assets, but doesn't really note the range of tools and governance structures applied by insurers to mitigate the risks. So, in particular, the paper raises concerns with respect to valuation, uncertainty, illiquidity, hidden leverage, complexity. But we've observed that the majority of insurers manage these exposures using pretty robust internal credit models, stress testing, and comprehensive enterprise risk management frameworks, frequently reflecting existing solvency framework requirements. For instance, valuation practices, while not 100% uniform, generally benefit from rigorous independent review by qualified third party firms with specialized expertise in less liquid asset classes. And with respect to illiquidity, it's important to note that life and annuity insurers are, by necessity, buy and hold investors with both the intent and the ability to hold assets for an extended period of time. And also note that insurers employ stress testing tools that incorporate a broad range of macroeconomic scenarios and policy holder behaviors to guide strategic and tactical management of cash and liquidity positions to minimize the likelihood of becoming forced sellers, especially of illiquid assets, except in the most extreme scenarios. So, as the IAS continues to assess the role of alternative assets in connection with, these broader structural shifts that they observe within the paper, within the life insurance sector, and potential areas for enhancement in supervisor material that they publish, we really would encourage the IAIS to consider the existing tools and governance structures applied by insurers to mitigate those risks today.
One of the other things that we talked about is the IAS's desire to create sort of a principles based definition. So I want to get KBRA's view on the sort of need for a common definition slash classification system for alternative assets.
We agree that a clear and consistent framing of alternative assets will help regulators assess cross border investment trends, promote transparency, and improve comparability in reporting. However, we would also submit that refinement and alignment with industry practice is really critical to make sure that any definition is both analytically meaningful and practically implementable. So we would support a principle-based framework, but we'd also urge the IAS to take advantage of some of the work that has already been done in this area. So, for example, and we note this in our comment letter, we'd suggest that the IAS work closely with relevant industry groups, particularly the Standards Board for Alternative Investments, or the SBAI, which has already developed data standards and reporting protocols for alternative asset exposures. In particular, the SBAI's open protocol provides a pretty robust industry vetted approach to capturing asset class data, risk metrics, and transparency indicators that would materially enhance the utility and comparability of supervisory data collected across jurisdictions. So we really would encourage the IAS to build on these work streams rather than developing sort of a parallel definitional framework. In other words, just don't reinvent the wheel here if you don't have to.
I also want to think about the section on credit rating agencies. So, what were our views on the way that the IAS framed that discussion?
Well, we'd echo what the IAIS says in the draft issues paper, which is that credit ratings provide investors in alternative assets with insights into the quality of the underlying assets and the structural protections in place. investors also benefit from the diversity of opinion that different credit rating agencies provide to the market. There is some indication, and the draft issues paper seems to suggest that they perceive subjectivity and differences in credit ratings outcomes between different CRAs could be a drawback and indicative of CRA reliance on issuers where information might not be publicly available. But we would really offer a different or an alternative and a more positive approach or view of that. And that is that differences in credit rating outcomes among credit rating agencies reflect analytical judgment and different methodological approaches. Investors really benefit from diverse perspectives on credit risk. And, to the extent that there are, developing or ongoing concerns around herding behavior and concentration risk in portfolios of investments, multiple perspectives on credit risk from different credit rating agencies serve to mitigate those risks. I'd also just note that as background for listeners and as recognized by the IAIS, and as you noted earlier, Emily, CRAs are subject to comprehensive regulatory oversight in many jurisdictions, as well as global standards, which were established by the International Organization of Insurance Commissioners, otherwise known as IOSCO. Among other things, these regulations and standards promote quality and integrity in the credit rating process, independence, avoidance of conflict of interest, transparency, as well as the protection of confidential information. So these are really core principles that apply to all credit ratings, regardless of the sector or the asset class. Similarly, the risk of rating shopping or the potential for conflicts of interest are no greater in alternative assets than in traditional asset classes, and nor are the regulatory requirements, standards, or measures any different to guard against them. So we would really strongly discourage any suggestion to the contrary. Finally, I'd want to note in conclusion that I think, we've done a good job on some of the high level points in the IAIS paper and would encourage our listeners to take a look at KBRA's comments and really take a closer look at the draft issues paper as well and some of the underlying material in there. The consultation paper is public and comments will also be made publicly available so people can take a look at those.
Yeah, I would definitely encourage listeners to take a look at not only KBRA's comments, but to also read the full paper. The issues paper is 75 pages long, so we've really just scratched the surface of it. And I think just from our conversations in the US alone, it seems like a lot of people are talking about the paper and I think commenting on it. So it will be interesting to go through all of the comments that they receive and watch as they progress on this topic over the next year or so, and also how it might inform international regulation. So definitely something to watch. Thank you so much, Ryan, for coming on to discuss.
Thank you.
This concludes our episode. Thank you for tuning in. New episodes of Policy Pulse air every month. In the meantime, please visit kbra.com to access our other podcast series, as well as our ratings and research.